Hey, Facebook, welcome to the Twin Cities Real Estate Show. Today, we're going to be talking about most misunderstood terms in real estate. Make sure you stick around for our after show. You guys ready?
Ready.
All right. We'll do the after show as soon as we're done recording the main show. Here we go. Are you thinking about buying or selling a home, or just want to know what might be going on with one of your biggest investments? Then come hang out with us for a little while. Hi, I'm Kirk Duckwall, and welcome to the Twin Cities Real Estate Show, sponsored by Bricks Real Estate Network Title, Eric Bloomstrand and Chad Priebe with Bell Bank Mortgage, and James Stolson with Country Financial. If you have any questions for us, make sure you give us a call at 651-303-0019. Again, 651-303-0019. Make sure you check us out online anytime as well at brickstwincities.com for the latest and greatest home searching and researching tools. There you can also find our couple free books that we have, The Smart Home Buyer and The Smart Seller. The way I like to put it is, would you read a book for $10,000? If so, read those books, because whether you're buying, it'll show you how to save a ton of money, and if you're selling, how to make a ton more. So it's well worth the time. Each one of those books maybe takes all of about 30 minutes or so to read. You can follow us as well on Facebook, where we record live most Tuesdays around noon. All right, I'd like to welcome to the studio Erica Carlson with Bricks Real Estate. Thank you for coming in.
Thank you.
And Chad Priebe.
Hey, thanks for having me.
Thanks for coming again.
Yeah, you bet.
See,
Great
I had to
to
make
be
sure I did the intros this week, since last week I completely skipped them.
That's okay. I mean, we had a lot to talk about.
We did. And so we're going to hit on misunderstood terms, and we run into it a lot, and a lot of it has to do with just the nuances within our industry, and these phrases get thrown around, but there are like serious implications, and it's worth knowing what these are and how we perceive them as we're moving through a real estate transaction.
Absolutely.
Okay, the first one sounds so simple, but it really is important, and that's the difference between a condo and a townhome. Because what looks like a townhome and smells like a townhome might be a condo.
Right.
And how, Chad, is that possibly going to affect somebody's loan?
Yeah, that's a good question, and you're right. This is very important. So if you're in the market to purchase a condo or a townhome, make sure you're talking to your loan officer and your real estate agent about that right away, because there's different types of financing that could prevent you from being able to purchase a condo. And one of those terms is an FHA loan. Some condominium associations, they don't accept FHA financing. So if you're out looking and you come across a condo you fall in love with, make sure it's FHA approved, because it can really hurt your feelings.
Right, and not only is there the implication for FHA and buyers, but correct me if I'm wrong, but isn't there a different pricing adjustment for a property that's classified as a condo?
Yes, great point. So if you're in the market to purchase a condo, be prepared to pay a little more in the rate, and usually that difference is about 1/8%. And then your traditional townhouse is just your standard rates.
Right. So then when people are shopping around, this is why we say don't fall for the clickbait, because each individual person's situation will have a different interest rate for them. What is your down payment? What property type are you buying? What's your credit score at? All these things play into where rate falls. And so there's an order to shopping you want to follow that we talk about. First, what is the property type? Second, what is your down payment, right? And make sure you're expressing these things to loan officers as you're looking around. How long is the term you're going to do? Because that's going to affect your interest rate.
Huge, big
right?
deal. Absolutely.
Talking about rates, wow, kind of low.
Amazing, yeah. I know we're all in a great market right now as far as interest rates. So if you are in the market to take a look at your options, it's a good time to.
Yeah, you're
to
getting hit left and right with refis.
Yeah,
I didn't honestly think we would see a refi boom.
I didn't either, and so this is great times, and again, the refi boom is definitely what we're in. So. If your rate is 4% or higher right now, it's probably a good time to take a look at it and do a little tune-up on that loan.
So, okay, moving on with different terms. Earnest money, what is it? and how is it used, and what's the importance of it. So it basically, earnest money is money that you put forward to tie down a property upon acceptance. Think about it like if you go to the car lot and you say like, hey, here's $500, hold this car for me for a day or whatever, right? That's kind of what you're doing with earnest money. Here's 1% of the loan amount, or 500 or 1,000 or whatever. It does make sense, especially in a competitive market like we're in, to put forth a good strong earnest money amount.
For sure.
It shows a commitment level, but it also how it applies, because when you're thinking about how much do you need to bring to closing, if you have, let's say, a 5% down loan and you're doing 1% earnest money, then you have to bring the 4% more at the time of closing.
Correct.
It is how that goes.
Yep. And earnest money can be very challenging at times if you don't, again, talk to your loan officer and your real estate agent up front about how you're getting that money, because cash is always good on the streets, but when you're applying for a mortgage, cash is not good. So if you are in that market to start looking at your pre-approval options and you have cash, that's fine, but get it in the bank. Let's let that money sit in the bank for a while, preferably a month or two at the minimum, and then we won't have any issues.
I think the big thing is that people need to understand they can get the money back, or it can
Right.
be used. I think that's where we get worried when we're representing buyers, is I think they want to know those opportunities where if they have to back out of the deal. And so that's why we do the contingencies, which I know we're going to jump
exactly.
to.
Well, I'm going to actually bring that forward as we're going. I'm thinking of different spots. I want to mention some of this. So I think contingency, that is your due diligence period, and your earnest money is refundable during that inspection contingency period of time, and to a certain extent is refundable during the financing contingency time. So you want to know this, and there are nuances to each transaction, what you ultimately decide to put forth, and like when you're going to give that earnest money as well. I mean, there is a standard that you're going to deliver it within 2 business days, I think, of the accepted contract, or 2 days. Now, see, now I'm messing it all up.
No, you said it fine.
Well, I mean, one of the things that I do and is I usually say, especially if it's not competitive, I will say I will deliver it after the inspection contingency is cleared. And most of the time, no agents have a problem with that.
I love how you do that, by the way, because that doesn't tie up people's money if something were to
happen.
Well,
there are certain companies that it can take upwards of 30 days to get that money refunded,
yes.
Which is a problem. And actually, I got into a transaction where that came up as far as, like, they're like, well, why don't you want to submit until after the inspection? I said, well, because your company policy takes about 30 days to get it back to us. And so they go, okay, that makes sense. They agreed to it. So most of the time, if explained, I get the other agent to accept that. It also saves paperwork. If somebody's going to withdraw, that you have to then refund that back.
Well, especially on the, if you're looking to turn quick, and especially in today's market, if you have to wait for that refund, you may not have that cash for that next offer.
And honestly, I don't push hard if a selling or listing agent is saying, you know what, we want it in that time. Okay, fine. I do it more. It's just it is just to make things easier overall. So it's not a point I push on, but it's refundable. So if I hand it over at the end of the day, they are gonna ultimately get it back if they back out during those times.
Right.
Are you writing that in your contracts, or?
Yeah, it's the other section.
You do the other.
I put it in there. So. Okay, so yeah, contingency, it's a period of time where you're doing your due diligence, and escrow, that's the money you're putting forth to lock it up. Let's talk about, let's see, I think this is a good one. That's a good one to get to when we come back. Appraisal value. Let's do that. Let's do that one. So often, buyers and sellers are guilty of looking at appraisal value as if it is market value. Mm-hmm. And really, Chad, I mean, I think you'll back me up on this. It's a risk assessment for the bank to do to see do they want to lend this money up to X dollar amount on X property.
Precisely, yeah.
Right.
Exactly.
And I mean, you see that there can definitely be differences between market value and appraisal value.
Definitely, and there's difference because an appraisal is an opinion of value. So, one appraiser might have a different opinion than the next.
Right. Well, and just as another buyer will have a different opinion, and hence why you see in a multiple offer situation, you don't usually get two offers exactly the same. It happens occasionally, but if you break down all terms, that usually doesn't happen. So, if you're looking for that appraisal value, and where I see the most confusion is a seller like, well, how do I determine the value of my house? Do I go get an appraisal? No, you want to get a comparative market analysis through your agent. We'll talk a little bit more about that along with some of the other valuation stuff once we get back from our commercial break. Again, you're listening to the Twin Cities Real Estate Show on AM 950. We'll be right back. This is the most exciting time for Facebook to watch.
I just want to cough.
Sitting there going, what are them guys doing?
Yeah, they're just like, why are they sitting there frozen? Okay, you guys ready for that?
10 seconds?
Yep. Okay. Let's see. We did that. There we go. Let's talk about that. All right. Ready?
Absolutely.
Here we go. One note to myself.
This one here might be a good one to touch on.
Oh, yeah. We'll get there.
Okay.
I hope.
Yeah.
That counts down to the commercial?
Yes.
Yep.
Oh, okay.
Yep.
Wasn't sure what it meant.
Well, now this time it's going to count down to the end of the show.
Okay.
Got it? So here we go. Welcome back to the Twin Cities Real Estate Show on AM 950. Today we are talking about the most common misunderstood terms in real estate. And we kind of left off with appraisal as to how to use that, right? It is basically a verification of risk assessment that a bank is willing to take on, right? That is what the purpose of an appraisal is, not to establish the value of your home. Okay, so you want to, when trying to establish the value of your home, is to reach out to a local real estate professional and have them come out and do a market analysis, a comparative market analysis. Now, there are these things that are called automated valuation tools or automated appraisals.
Mm-hmm.
These are useful data points, and their primary purpose in the industry is not so you as the homeowner can find out exactly what your home's worth. It was originally designed for the lending industry to basically find out if they even need to do an appraisal on a house, right?
Correct.
Right, because you can get appraisal waivers.
We are, and we're seeing more and more of those based on the statistics that Freddie and Fannie keep. But there is still the AVM on the lender side. We use those mainly for your VA interest rate reduction type of loans. But it doesn't really give you the fair, honest value of your property.
Right. So a market value is taking a lot of things into consideration that these tools, these automated tools, don't, right? These automated tools are looking at past data, right?
Correct.
They aren't looking at like showings per listing per week, what's happening right now in the marketplace,
Exactly, right.
And so there are these opportunities of the market where you can capture a much higher value, or possibly if the market's not performing well, a lower price. Now, granted, that's not the case right now,
No.
but you want to have a person looking at these different data points and looking at the market. It's looking at those sales. And I'm going to add another term that I didn't have written down, and that is what is a comparative sale? What is a comp? What is a comparable home? And in that seller book, and I might as well promote it now, if you're interested in the free book that we have, you just go to brickstwincities.com under publications, the Smart Seller book. A lot of great information in there. But one of the things that I wrote in that was, what is a comparable sale? Sorry to burst a lot of people's bubbles, but more than likely it's not the house next door to you or across the street. Okay, that would be going at it with the same thought process as walking into a car lot and comparing the pickup truck to the minivan that's parked next to it, right? You got to make sure that you're comparing features, right? What is it? Like, is it another, if you have a one-story home, are you looking at a one-story home as your comparative, right? How new, as far as what age is it in? So I usually might do, plus or minus, depending on the neighborhood, 5 or 10 years, right? Is it within that age group? What's the size comparison, right? As you get too big of a size difference, it starts to become hard to make adjustments.
Right.
So, I'm usually, again, doing plus or minus a few hundred square feet, right?
And on the lending side, too, when we're looking at comparables, we're looking at, houses within a half a mile of the house that you're selling or looking to sell, and probably sold within the last 6 months. Now, if the appraiser can't find anything in that area, obviously they can go outside of that range, but that's giving you the most accurate information.
Yep. Well, and I like you bring up some of those things, because that's where on the lending side it's done a little differently than I might take it on for market value, right?
Mm-hmm.
So yes, I do like recent, but where 6 months can be a problem for me is if I'm getting ready to put a home on the market in the spring market, and I look 6 months back, I'm looking at a market that's sliding seasonally versus a market that's growing seasonally. So I want to look at a year or potentially 2 sometimes to see what is that growth each year in the sales. I usually, though, I keep it even tighter than a half a mile. I would rather be close and go farther back sometimes and then do the adjustments from there than jump into a whole nother neighborhood. And each agent has different approaches that they will use to do this. And I think, at the end of the day, especially if you're using multiple data points and the more and more comparables that you have, the better analysis you're going to get.
Definitely.
On
Just
it.
hit it right
So,
on the nose.
Yeah, a comp sale, you really want it's size, location, style, condition even. Now, condition can tend to be one of those you can adjust more easily for, but that is something else that I do want to see. Like, I have one that I'm doing an analysis for. Well, I started on it last night. But like, the owner was smoking in the house. So, what's the adjustment you make for that?
Yeah.
Right?
What is the adjustment you make for that? That's a tough one.
10 to 20K
Really?
usually. Yeah.
Wow.
Yep.
That's major money.
It is. Yeah, it's way cheaper to put in the new carpet and paint it.
Yeah.
Wow.
Again,
Again, we reference that in that seller book, like what the implications are of that.
it's amazing.
Okay, here's another one you wanted to touch on, which is escrow.
Yeah, that's a big one.
Right, and what is it? How is it used? Like, so most of the time when somebody maybe hears about escrow, well, if they're not from Minnesota, they might think you're talking about the closing.
Correct.
Right?
Yeah.
Or they're thinking you're talking about taxes or insurance escrows.
Correct.
Right? But there's another way that we use it. Right?
Are you talking about escrow holdbacks?
Yes.
For work to be done?
Yep.
Okay, yeah, that's a big one. So, especially in the winter months in Minnesota where, maybe the roof cannot be repaired. So if the appraiser's out there or the home inspector finds maybe an issue with the roof or something outside, maybe paint, chipping and peeling paint with FHA financing, we can't do that in the winter months, unfortunately. So there's a thing called an escrow holdback or a work order where we'll hold back 1.5 times the cost of that fix. We'll hold that in an escrow account or savings account, we'll call it, until you can complete that work. Then we'll release the funds back.
One thing I just completely jumped past, and you had mentioned this one, Erica, which is the tax value.
Yeah, you were going so fast.
I'm sorry. I was talking about market value. Well, okay, so I said data points, right? Yeah. And so you have tax value. And we see sellers looking at that data point as
a major point
as
to them.
market value.
Yep.
Right? Now, when I went through real estate school many a moons ago, well, we were basically that the taxable value is supposed to be roughly 80% of what the market value is, according to the county. That was the general calculation.
That was back then.
You're right, and now I think it's gotten very butchered as
I
to
don't think they're talking about it anymore. It's just not a data point that we
really look at.
Not you and me.
No.
Not as agents. I mean, I'll look at like what the third-party websites, are talking about, just to see what the consumer has in their mind before I meet with them.
Right.
But I do want to know the tax, because if somebody has that data point in their mind, I need to know that going in.
Right.
They might think their valuation is here, but it might be a lot more.
Yeah, well, and I tend to see it's more undervalued than overvalued. Would you say that's the case?
Well, also, a lot of times people aren't getting in. If you remodel your basement, you put in a brand new kitchen, a new bathroom, a lot of people aren't going to call up the county.
Right. They don't want to
Right.
And say,
taxes.
hi.
Hey, do you want to raise the taxes? Yeah.
It's a delicate topic, but it's, I don't think that they always have the full picture of the property. They have exterior more, I would say, than interior, right?
Right.
And we like to come in to see.
Oh, I mean,
what's
like I was
happening
measuring up a
inside.
house last night that was off by 300 square feet over what the tax value had.
That's a huge
right?
number.
Well, and that's another thing. When you are looking at these
Yep.
data points, we just got a few seconds to go here, but when you are looking at these data points from these third-party websites for value, if they have the square footage that's in the tax records, boom, it can throw your value.
You can find yourself a really good deal.
Well, yeah. I mean, it can maybe be way underpriced in that scenario, or if it's high.
Yeah.
If somebody ripped out a basement because they had a water problem or something, right?
Right.
So you got to make sure that you're taking all of those into consideration. Well, as usual, we did not make it through all the terms that we wanted to cover, but. Again, if you have any questions for us, if you're thinking about buying or selling a home, just want to pick our brains, feel free to give us a call, 651-303-0019. Again, 651-303-0019. Erica, thank you for coming in today.
Thank you.
Chad, as always, pleasure.
My pleasure. Thank you.
All right. We'll be back next week. All right, the after show.
This is when the fun starts.
Yeah, that's fun. I do. I want to do one of these days when we end the radio show. We got to do like the anchor man.
We can do it right now. Right?
He just did it.
What do I do with my hands?
What was the lady's name? that they were
Veronica?
with? Yeah.
Corningstone?
Yeah, that's
Yes.
me.
It's me.
Let's do it again, and we'll dress up, because they can't see us on the radio, but these guys can see us.
Well, the
so
other one
we
is
it's
the
real.
How I Met Your Mother, where the guy never wore pants. He
We're
always
not
had
doing that
boxers,
one.
so he'd stand up. He had the suit coat on, but you never saw it. It's at the end of the show. He'd stand up and never had pants.
Oh, God. That's
bad.
great.
Okay, well, that's a little off topic, but
Yeah, it's okay. You got to have some fun, too.
okay, so thank you for sticking around, anybody who's watching on Facebook. Okay, so a few of them that I wanted to touch on. Here's a good one. Easement versus encroachment. I have a lot of people that'll freak out. Oh, there's an easement on the property. What the heck? Well, almost every property is going to have a easement. It's going to be a utility easement for the sewer running through, or for power lines, for city streets, all of that. That's normal. Easements
normal.
You don't
are
really
normal.
own, 8 or 10 feet
Yeah, it just
on
depends.
the perimeter. Yeah.
Yeah.
I mean,
It's kind of common.
I'm just
Yeah.
Yeah, like I'm.
like when you're mowing.
Yep.
Right. You're kind of mowing somebody else's.
Yeah,
I mean,
Right.
you really find out when you put a fence in.
yeah.
If you're
Yeah.
not sure where it is, you find out when you talk to the city and say, I'm going to put this fence in, and they say you cannot go all the way up to the curb.
That's why you want
They
to pull.
typically
Right.
get the rights.
Yep.
Yeah.
And you're like, what? I gotta mow that?
Nothing worse
Yep,
to
you
find
do.
out you got to tear your shed down because you're on the city easement.
Yes.
Yeah.
Yeah. Well, or move it. Yeah.
move it.
Yeah. I ran into that not too terribly long ago. They didn't tear it down, but it's just like, well, if the city comes in and says they need to get a backhoe there, you
Right.
need to move it.
But
so
an encroachment is like a tree.
an encroachment would be, let's say, a neighbor built their garage partially onto your land.
Yeah, that's a big deal.
Right. That's an encroachment.
Correct.
I have a commercial property where the my seller has a building that's encroaching into the city right of way. Right. Now,
Uh-oh.
every building on that street has that problem
Okay.
because they increase the size of the right of way at a certain point. So they're willing to issue variances on that. But it's when somebody property goes over, you're encroaching onto their land, right? So now that's a bigger deal than a easement.
Yeah, it becomes an issue with title and lending because you technically don't own that. Whatever part of your house is on that,
Right.
you don't own that. And if the city comes in or county or whatever, and they have to, if there's a sewer line underneath that land or whatever, you're
in trouble.
probably going to miss some of your house.
There is an issue.
Just a little bit.
I showed a house where if you bought it, you had to share the driveway with the neighbor. Like where the neighbor was going to come around the back and the buyer was asking me, well, can we get rid of that? And I was like, how would they get to their garage? And we're standing in the backyard. I'm like, well, this is why this exists. The street had been changed at some point historically.
Right.
That was the only way they could get to their garage.
Well, in St. Paul, where we're recording, there's tons of shared driveways.
Yep.
That's just
common.
normal. Okay. Rent to own versus contract for deed. This is one that actually came up with one of our clients where she went to one of our classes and was interested. Had reached out and said, well, what do you know about rent to owns and contract for deeds? And I said, well, be very careful with any rent-to-own. I mean, I personally look at them as consumer scams for the most part, right? Because you don't hold any rights to that property.
Right.
So they're going to charge you this higher rent and supposedly put money away and supposedly lock it in at a price, maybe.
You better read the contract.
Yeah, you better read the contract, right?
You better get in title right away, otherwise.
Well, and that's why contract for deed is the better route if you're going to do it. And honestly, like, most people's credit situations, if you're proactive, you can fix it within 6 months to a year, right? And what you'll find is that if you do that, you get yourself into the position, and this is why a lot of contract for deeds may not work out, is a person gets themselves into a financial position where they can actually buy real estate with a mortgage, and they're like, well, I don't want this house anymore. I want to choose from a better pool of houses.
Exactly.
Right?
Yep.
Because usually a house that's selling contract for deed in a market like this is overpriced or in really bad condition.
I was going to say bad condition.
Right?
There's just not that many either. So when somebody really wants one,
right,
it feels like you're really wading through a lot of inventory that you can't show. Because a lot of people aren't going to be comfortable being your lender. Because we're talking about regular people now.
Weren't the contract for deeds more popular when the rates were extremely high
Yes.
and people just couldn't qualify for the...
Yeah, well, either rates were high or the requirements were too strict, right? So we saw more of that. Foreclosure, I think this is a good one. I'm looking for foreclosure homes, right? Well, what you're actually saying is I'm looking for homes that are in the foreclosure process. Once they are foreclosed upon, now they become lender-owned, bank-owned, properties, right? So usually you are not going to be able to buy a foreclosure home. You can buy a foreclosed home. The only exception to that is if you're buying a short sale that's in foreclosure. Now, it's a nuance, I know, but... Well, I mean, it comes up. I get the question a lot because of the low inventory right now. People are looking at these properties that are in the foreclosure process, and they're like, well, can't you just reach out to the bank? No, because the bank doesn't own that property yet. They're
in the redemption period.
Right. You want to run down that rabbit hole, and trust me, I've chased it all the way to either the Department of Housing and Urban Development
Yeah.
or chased it all the way to Fannie Mae or Freddie Mac, right?
To get nowhere.
To get nowhere,
Yeah.
right? You're not going to get to the bank because, like, if you look and you see that Big Bank USA is holding the note, they're not usually the one. They're servicing it,
Yeah.
but they're not the end investor in that, right?
Right.
They're not the decision maker. So you're not just going to the bank.
Yeah, you're not going to go after Freddie or Fannie.
Right. Now, can you approach a seller and see if they might be willing to do a short sale? Yes, you can, along with every other investor, real estate agent,
If
or a
they can.
person. Yeah, if they can find them.
Well, if you can.
Yeah.
Not
Yeah.
everybody's able to sell short.
Mhm.
So
Right.
there you can ask, and we're getting into some more complicated. But here's the real question for the buyer: are you trying to find a deal?
You
'Cause
hit it right on the nose.
That's the real question. If you tell me you're interested in short sales and foreclosures, my next question is, do you want a deal? Because then that's maybe a different question than trying to find bank-owned property.
Right. Yeah, no, and that's right down the path that I usually lead
Mhm.
people, which is, well, let's go look at estate sales and let's go look at relocations,
Yeah.
right? Now you're not dealing with stuff that's conditionally just
Yeah.
beat the heck up.
Right. And
Yeah.
they're overpriced now, too.
Well,
with
yeah,
today's
well, and one
market.
of the things that we saw last week's show where we were discussing the time on market trends, the time on market for below 200,000 is actually going up because they're in such bad shape
Oh.
that
People don't wanna
the
take
people
them.
don't want to
Just
take them
sitting
on.
there.
Yeah, it's really weird in a fast market that market is going up in time, but it's because of that.
Well, because we're in a market where people want the work done.
Yeah.
Right? Like a lot of us don't want to put that effort into paint and carpet and
Yeah.
Well, I think we hit on what we should.
Good show.
All right.
Absolutely.
Hit us up on Facebook if you have any questions. Otherwise, see you next week.
Have a good week, everybody.
thank you.